Silver did not collapse randomly. It repriced precisely when systemic pressure reached limits. That precision matters because chaotic markets behave differently from mechanically constrained financial systems. When panic dominates, prices swing erratically, spreads widen unpredictably, and liquidity evaporates unevenly. This event displayed none of those characteristics which immediately raised analytical concern globally. Instead, silver moved cleanly, decisively, and simultaneously across liquidity-sensitive trading venues worldwide. Such behavior usually indicates forced adjustment rather than discretionary fear-driven selling activity. The timing aligned with leverage thresholds, margin requirements, and volatility expansion points globally. To understand why this occurred, we must examine silver market structure carefully today. Silver trades primarily through futures, creating leverage layers above relatively shallow spot markets. This structure magnifies stress because small imbalances produce outsized price responses rapidly system-wide. Unlike equities, silver lacks deep passive demand during sudden volatility. Events periods historically, industrial buyers hedge gradually leaving futures, markets temporarily unsupported during shocks phases globally. Before the crash, warning signs accumulated quietly beneath surface level, price stability conditions. Open interest expanded while momentum stalled, a classic indicator of leverage, build-up pressure. At the same time, implied volatility remained suppressed despite rising macroeconomic uncertainty globally. Low volatility encourages risk-taking until sudden repricing becomes unavoidable across leveraged markets. Meanwhile, global liquidity conditions tightened, raising funding costs and collateral sensitivity across institutions. Higher, short-term rates change position economics without requiring negative headlines immediately visible. Positions sustainable under easy money regimes become unstable when financing tightens abruptly system-wide. This transition phase is where silver historically experiences sharp, discontinuous moves during shifts. Importantly, the crash occurred without a triggering news catalyst event or announcement whatsoever. Absence of headlines suggests internal market mechanics drove the repricing process forward decisively. Mechanical selling follows rules, margin calls, risk limits, and volatility controls simultaneously triggered. Once thresholds are crossed, selling accelerates regardless of participant conviction or narrative preference. This explains why price action appeared deliberate rather than chaotic. Behavior patterns observed, correlation behavior during the move, further supports a liquidity-driven explanation over sentiment. Silver failed to behave as a safe haven during the sell-off phase period. Instead, it moved alongside other balance sheet-sensitive assets under liquidity stress conditions. That pattern indicates forced deleveraging rather than fundamental reassessment of long-term value. When balance sheets contract assets reprice quickly to restore equilibrium across markets globally, silver often leads these adjustments because of its market size, relative leverage exposure. Smaller markets cannot absorb synchronized selling without violent movement occurring extremely rapidly today. Historical episodes show silver repeatedly breaking during liquidity regime shifts across decades globally. These breaks surprise retail participants because narratives lag structural stress accumulation within systems. Institutions monitor exposure, not stories, and reduce risk preemptively based on constraints. Models retail traders interpret speed as manipulation rather than constraint, release driven by leverage. The word scripted reflects predictability, not coordination or intent within market structure dynamics. Given inputs, the output becomes statistically probable rather than accidental under stress conditions. Stress models anticipate exactly such moves when leveraged saturation occurs across futures markets. What shocked many was not magnitude, but timing, accuracy relative to macro conditions. The move arrived precisely when multiple tolerances were simultaneously breached across systems globally. This convergence makes outcomes feel inevitable in retrospect, once conditions align fully system-wide. After the repricing pressure eased almost as abruptly as leverage reset occurred broadly. Such stabilization often follows forced liquidation phases as positioning normalizes gradually afterward again. This reinforces the argument that the move was structural rather than emotional selling. Understanding this helps distinguish opportunity from panic-driven error during volatile market phases. Many participants exit at extremes, misreading mechanics as catastrophe instead of adjustment process. Silver resets tend to mark transitions, not conclusions within broader cyclical structures forming. What follows matters more than what just occurred for forward-looking risk assessment. Signals now shift toward liquidity, stability positioning, and volatility behavior across sessions ahead, ignoring structure risks, repeating surprise when next threshold breaks under evolving conditions again. The system did not malfunction. It operated exactly as designed under stress parameters. Design prioritizes stability through rapid repricing over prolonged disorder during leverage unwinds phases. This design choice reduces contagion, while increasing short-term volatility during resets events. Participants uncomfortable with this dynamic often misinterpret its intent because outcomes feel abrupt. In reality, abruptness is a feature of modern leveraged markets under stress conditions. Silver exemplifies this because its ecosystem amplifies leverage interactions across participants globally today. Calling it scripted reflects recognition of system logic operating under constrained liquidity conditions. Once inputs align, outputs become effectively predetermined by structural rules and constraints present. The discomfort comes from realizing discretion played little role during this repricing event. This challenges narratives of control, randomness, and fairness within financial market dynamics today. Understanding mechanics restores agency by improving risk anticipation during future liquidity. Transitions periods, those prepared interpret such events with clarity rather than fear during repricing cycles. Those unprepared perceive conspiracy where mathematics dominates outcomes under leveraged market structures globally. Silver's crash therefore serves as an educational signal for understanding modern market behavior. It reveals how stress exits systems efficiently when thresholds fail across markets today. Such exits feel harsh, but prevent longer destabilizing spirals from forming unchecked system-wide. This perspective reframes the event from catastrophe to adjustment within broader market evolution. Adjustment phases reset risk, allowing healthier participation afterward once leverage normalizes and liquidity. Whether silver stabilizes now depends on post-reset conditions, including funding costs, volatility. Monitoring these variables matters more than emotional reaction during headline-driven commentary cycles. The first lesson is simple structure dictates timing when pressure accumulates beyond tolerance. The second lesson is leverage hides until it breaks violently under stress events. The third lesson is silence often precedes the loudest moves within markets today. Silver followed this script because the system required it under prevailing liquidity constraints. That requirement explains why it happened exactly when it did across global markets. Understanding this prepares observers for future silver volatility cycles driven by structure. Again, ignoring it ensures repeated surprise as similar conditions reappear within leveraged markets repeatedly. This concludes the foundational explanation of the initial silver repricing event dynamics discussed. After the reset, the silver market entered a different phase of stress globally. This phase is defined less by collapse and more by information recalibration processes. Forced liquidations cleared excess leverage, but they also changed participant behavior patterns permanently. Markets rarely return immediately to equilibrium after such abrupt structural adjustments. Events globally. Instead, a period of reassessment follows where risk tolerance remains temporarily reduced everywhere. Participants become sensitive to signals previously ignored during complacent expansion phases globally earlier. The sensitivity manifests through lower leverage usage and quicker position trimming. Behavior, system-wide, volatility. Expectations rise not from fear, but from memory of constraint exposure. Recent. Such memory reshapes strategies, particularly among institutions operating under risk mandates globally today. Post-crash environments often see reduced liquidity, even without further price declines appearing. This liquidity reduction reflects caution rather than inability to transact efficiently. Temporarily system-wide market makers widen spreads to compensate for uncertainty around future volatility risks globally. Wider spreads dampen short-term participation, reinforcing stabilization through inactivity periods aftershocks. This creates an appearance of calm that can be mistaken for resolution finally. In reality, unresolved pressures often persist beneath surface pricing. Behavior metrics quietly longer. Silver specifically remains exposed to macro forces still evolving. Post-reset environment globally. Interest rate expectations continue influencing opportunity costs for holding non-yielding assets worldwide today. As long as rates remain elevated, silver demand remains structurally constrained across markets. However, constrained demand does not imply inevitable decline without new stress catalysts emerging. Instead, price behavior becomes more sensitive to marginal liquidity, shifts occurring system-wide suddenly. This sensitivity explains why rebounds can be sharp yet fragile after crashes. Historically, without renewed liquidity, expansion upside moves struggle to sustain momentum beyond short bursts. Therefore, observers should not confuse stabilization with strength during recovery phases following shocks. Another implication of the reset involves confidence, erosion among retail participants globally. Today, retail traders often experience disproportionate losses during rapid mechanical repricings, events causing withdrawal. This withdrawal reduces speculative participation, altering market microstructure temporarily. Afterwards, following resets. Periods, reduced speculation lowers noise but also decreases natural countertrend liquidity, availability during stress. Thus, markets become more binary, reacting strongly to limited new information. Inputs, suddenly, institutional players adapt faster, leveraging data, feedback, and historical pattern. Recognition models continuously. These adaptations widen the gap between informed and uninformed participants during volatility cycles. Silver, therefore, becomes a teaching instrument revealing structural inequalities within markets globally. Today, such revelations often spark emotional reactions, but rarely change system mechanics directly, immediately. The system continues prioritizing balance, sheet protection over participant experience during stress events. Understanding this priority helps frame future expectations realistically for participants, observers, analysts worldwide. Following the crash, attention shifts toward regulatory responses and monitoring efforts, intensifying gradually. Regulators analyze whether the event reflects isolated dynamics or broader vulnerabilities. Forming system-wide, increased scrutiny does not guarantee intervention, but raises compliance pressure for institutions, affected compliance costs. Further strain. Smaller participants reinforcing consolidation incentives across banking ecosystems globally. Consolidation reshapes market structure, affecting liquidity, distribution, and pricing behavior over time periods. Such structural evolution occurs gradually, but its effects compound significantly across cycles globally. For silver, this means future volatility may appear episodic rather than continuous. Moving episodes cluster around macro inflection points, liquidity shifts, and policy changes globally observed. Investors tracking these inflections gain advantage over reactive decision-making during turbulence phases. Reactive behavior increases risk of losses during rapid repricing events, especially without preparation. Preparation involves understanding structure, not predicting headlines or narratives that drive sentiment cycles. The silver crash underscores the importance of structure literacy among market participants everywhere today. Those with literacy anticipate stress rather than reacting. After damage occurs, inevitably system-wide. This anticipation does not eliminate risk, but improves decision quality during volatile periods. As markets digest the reset, attention turns toward next vulnerability points emerging globally. These points often involve funding markets, derivatives, exposure, and collateral dynamics interacting complexly. Silver remains embedded within this web, making it sensitive to shifts therein constantly. Therefore, vigilance matters more now than during pre-crash complacency periods. Historically observed, market memory fades quickly, but structure persists, shaping outcomes repeatedly over time cycles, ignoring structure risks, repeating mistakes when conditions align again across markets. Globally, later, silver will not always move, but when it does, moves matter greatly, system-wide. These moves signal broader liquidity health beyond the metal itself, reflecting system-wide conditions. Understanding signals requires patience, discipline, and resistance to sensationalism during crises, reporting cycles. Sensational narratives obscure mechanics and encourage poor timing decisions. By participants globally, often, clear analysis separates cause from consequence within complex market behavior structures evolving continually. This separation empowers rational response rather than emotional exit during stressful repricing events. Silver's reset thus becomes a lesson rather than a warning alone for participants. Lessons learned improve resilience across portfolios, strategies, and time horizons when applied correctly. Applying lessons requires humility, acknowledging limits of prediction within markets globally, always present. No model predicts timing perfectly, but structure narrows probability, ranges significantly during stress. Silver's timing was narrow because constraints converge tightly across systems globally, simultaneously, then. Recognizing convergence early distinguishes preparedness from surprise among market participants globally today everywhere. As conditions evolve, similar convergences will occur in future cycles. Inevitably, under leverage, silver may again act as messenger before broader markets adjust their exposure profiles. Watching silver, therefore, offers insight beyond its standalone narrative for macro observers globally. This insight becomes valuable during uncertain transitions between regimes involving liquidity cycles worldwide. The crash marked transition, not termination. Within silver's longer story still unfolding ahead, Part 2 emphasizes forward-looking interpretation rather than backward fixation on events alone. What matters now is response adaptation and signal monitoring across markets globally, going, those who adapt remain positioned. Those who fixate fall behind during future resets. Silver's crash therefore serves as preparation tool for what follows next within markets. Future stress events will reward understanding rather than speculation by participants globally. Again, this concludes the continuation, explaining implications after silver's precisely timed reset event globally. What ultimately defines this silver episode is not price, but interpretation. Afterward, interpretation determines whether participants adapt or repeat errors during future stress events. Markets reward those who understand structure rather than those chasing narratives emotionally. Silver's behavior revealed how modern systems release pressure without warning theatrics. Such releases feel unfair because they bypass human judgment entirely during execution. Algorithms, margins, systems, and risk controls act faster than perception allows humans. This speed advantage is intentional, designed to protect systems from cascading instability, yet it creates a psychological gap between outcome and understanding for participants. Bridging that gap requires education rather than accusation or emotional blame. Accusations feel comforting because they assign intent to impersonal mechanisms. Mechanisms, however, do not care about fairness, sentiment, or participation experience. They respond to inputs, constraints, and thresholds encoded within market infrastructure. When those thresholds breach, outcomes follow, regardless of individual positioning beliefs. Silver simply obeyed those rules during a moment of convergence. The lesson therefore extends beyond silver into broader asset behavior understanding. Similar dynamics govern currencies, bonds, equities, and credit markets under stress. Each asset expresses stress differently depending on leverage depth and liquidity structure. Silver expresses it violently because its structure amplifies imbalance rapidly. This amplification makes silver an early indicator rather than isolated anomaly. Ignoring early indicators invites surprise when broader systems adjust. Later, history shows early signals are dismissed until repetition forces acknowledgement. By then, adjustment costs increase and opportunity narrows for unprepared participants. Prepared participants focus less on prediction, more on readiness frameworks. Readiness means position sizing, liquidity awareness, and respect for volatility potential. It means accepting uncertainty while managing exposure conservatively during transitions. Transitions are when most capital is lost, not during clear trends. Clear trends encourage participation. Transitions punish overconfidence relentlessly. Silver's reset occurred during transition, not trend continuation or reversal. Understanding that distinction reframes the event as expected rather than shocking. Expected events still hurt when preparation is lacking. However, preparation requires patience during calm and discipline during excitement. Most participants reverse these priorities, chasing excitement and ignoring calm signals. Calm periods hide risk because leverage accumulates invisibly, then releases abruptly. Silver illustrated this accumulation. Release cycle with remarkable clarity. The timing aligned because accumulation had reached saturation across constraints. Saturation means no additional leverage can enter without destabilizing equilibrium. Once saturated systems become brittle, vulnerable to minor triggers. Triggers need not be dramatic headlines to initiate repricing. They can be mundane margin, recalculations, volatility, updates, or funding adjustments. These mundane triggers feel anticlimactic, yet produce dramatic outcomes. The contrast confuses observers expecting drama before movement. Modern markets invert that expectation. Movement precedes explanation often. Explanation arrives later through analysis rather than announcements. This delay fuels speculation, but clarity emerges for those studying structure. Studying structure requires effort, discipline, and resistance to sensational narratives. Sensational narratives attract attention, but rarely improve decision quality. Decision quality improves through probabilistic thinking rather than certainty seeking. Certainty is illusion within complex adaptive systems like markets. Silver's crash shattered certainty but offered probabilistic insight instead. That insight suggests future volatility remains possible under similar conditions. Conditions include tight liquidity, elevated rates, and crowded positioning. These variables remain relevant beyond the immediate event timeframe. Therefore, vigilance remains warranted even during apparent stabilization periods. Stabilization reduces noise, but does not eliminate underlying vulnerability. Vulnerability persists until conditions materially change across liquidity regimes. Liquidity regimes shift slowly then abruptly during policy transitions. Policy transitions influence silver indirectly through funding and opportunity costs. Thus, monitoring macro policy remains essential for silver observers. However, policy alone does not dictate timing. Structural saturation does. Saturation builds quietly across positioning, data, leverage metrics, volatility, suppression. Those metrics deserve attention equal to price itself. Price lags structure until structure forces repricing. Silver's repricing therefore communicated structural stress before narratives adapted. Future repricings will follow similar logic across assets, markets globally. Learning this logic empowers participants to act proactively rather than reactively. Proactive action may involve reducing exposure hedging or simply waiting. Waiting is undervalued, yet powerful strategy during uncertain transitions. Silver rewarded patience after the reset by stabilizing temporarily. Temporary stability allows reassessment rather than impulsive re-entry decisions. Re-entry decisions should align with renewed liquidity, support, not hope. Hope is poor substitute for structural confirmation in markets. Confirmation emerges through improved funding conditions, volatility, normalization, and balanced positioning. Until then, caution remains rational stance. Despite temptation to chase rebounds, rebounds occur but often retrace without new liquidity backing. Understanding rebound fragility prevents frustration during false recoveries. False recoveries exhaust participants emotionally and financially. Silver's story teaches restraint, discipline, and humility under leveraged dynamics. Humility accepts that markets move beyond individual control or fairness. Acceptance reduces stress, improves focus, and enhances long-term outcomes. Long-term outcomes matter more than single trade narratives. Narratives fade, structure persists, shaping repeated experiences. Therefore, mastering structure yields compounding benefits over time. This mastery begins with curiosity rather than certainty. Curiosity asks why systems behave as they do under stress. Asking why leads to understanding rather than reaction. Understanding leads to preparedness. Preparedness leads to resilience. Resilience does not avoid losses entirely, but manages them effectively. Silver's crash offered opportunity to build such resilience. Those who reflect gain more than those who react emotionally. Reflection transforms events into lessons rather than trauma. This transformation defines successful market participants. Across cycles, cycles repeat because human behavior repeats under uncertainty. Structure channels that behavior into predictable outcomes eventually. Silver simply followed that channel during its repricing. Recognizing channels matters more than blaming outcomes. Blame stalls growth. Understanding accelerates it. If you want deeper breakdowns like this, subscribe for future analysis. Share your thoughts below. Do you see silver as warning or anomaly? Your perspective adds value to the discussion and helps others learn.